everyone, Ben Nelson, the Everyday Real Estate Investor, here with another episode of the podcast. And hey, it has been too long. We need to have another financing update because things are changing all the time. Still hoping for some stability at some point, but at this point we need to do this regularly for sure because things are changing so quickly. So we got Grant Schroeder, Academy Mortgage, here again. Grant, thanks for being on the show again.
Thanks for having me, Ben. Always good to be here.
Awesome. Well, let's get into it. So, what is going on in the lending world today? It's been a couple months since we've had you on the show, maybe a few months even. So lots has happened and continues to happen. So where is the lending market right now? What are we seeing happening? And we'll get into where we see things going from here, and then we'll check back in a few months and see if you were right.
Well, we've certainly seen credit tighten across the board. Certain lending programs pulled back. You see it a lot, primarily with like your regional small banks. As credit tightens, they're looking for more liquidity, just basically to survive at this point because they're heavily invested. A lot of them in bonds, like we've seen with some of the bank failures, and the continued Fed tightening, raising rates, kind of with their blinders on, has created some havoc, of course, in the lending market, but. Rates haven't come down as soon as started to come down as we thought they would. I mean, we're getting positive news on the rate of inflation. That's coming down significantly. Your CPI, Consumer Price Index readings are coming down. Your Producer Price Index, the kind of a leading indicator for your manufacturers, your producers, before that ever reaches the consumer. But we're not seeing mortgage rates move lower. The combination of the jobs market on paper staying strong with the BLS jobs report, ADP, and some of the Federal Reserve, the more hawkish tone they're taking in their meetings. They did pause on their rate hikes at this last June meeting, but their meeting minutes just came out this week, and they were showing at least another one or two 25 basis point hikes through the rest of the year. They're a little worried about inflation. We can go into that, I guess, more when we talk about the Fed. But
yeah. Well, and in case people haven't listened in the past, Fed rate hikes don't necessarily mean interest rates going up. So sometimes it can have the opposite effect, or a lot of times, right? Because of a lot of different things. Can you just kind of recap on that really quick? Just quick version in case people have not heard on the show before.
Yeah, traditionally you'll hear from mainstream media, the Fed's raising rates again. Okay, it's a very general term. The Fed rate hikes affect the cost of consumer borrowing. Your credit cards, your variable auto loans, student loans, home equity lines of credit, forms of consumer credit, direct correlation with the Fed funds rate and the prime rate that people are borrowing at. The Federal Reserve largely is hiking the Fed funds rate over the last year and a half to fight and combat inflation. Inflation is bonds' biggest enemy, or one of their biggest enemies, and mortgage rates are based in bonds, called the mortgage-backed securities market. So many times the day or two following a Fed rate hike, we've seen over the past year mortgage rate improvement because bonds and secondary market investors like the fact that the Federal Reserve has been aggressively trying to fight inflation for the past year with 50, 75 basis point, like very aggressive rate hikes. And so you'd see mortgage rates improve because bonds like that. If inflation is coming down with the Fed action, they like that. But in the short term, I mean, the Fed rate hikes have slowed down. Inflation, the rate of inflation is clearly coming down, but we still have seen mortgage rates move higher, unfortunately. Like we've crested the sevens in the past week or two, just for like your primary residence.
It's challenging. And your investment loans are, we were talking about this yesterday about a lot of them, and you mentioned some of the loan programs going away. We on the investor side, but I'm sure there's some more tightening on the consumer side as well. But we had talked about you had a loan program for quite a while that was 10 years interest only, right? And then it amortized after that. A great loan program if you're trying to get cash flow in those early years and you don't care about that amortization and the pay down of the debt. Well, that's on hold for now, right?
Yeah.
So some of those a little more aggressive maybe loans are they're not maybe gone, but they're being set aside to see how things play out, right?
Yeah, as the economy is shifting, your investors, your lenders are curious what's going to go on. I mean, even with conventional products, your traditional loans that everyday consumers using, you're seeing little tweaks on the back end that a consumer's not seeing, like a little bit tighter debt to income ratio requirements, more reserve requirements, more like credit. The upper credit score used to be 740 as far as like interest rates and pricing go. Where now over the last month and a half, we're seeing that now move up to 780.
Yeah.
So every 20-point tier, 740, 760, 780, your interest rate and the cost of that is improving the higher your credit score. And that upper tier used to be 740. That's now 780.
Wow.
So.
Yeah. So just some tightening, which is probably okay. So, you look back to the financial crisis when everything, crashed, because everybody wants to bring that up like that. That's where we're at again, right?
Mm-hmm. Fog and mirror, get a loan.
Fog and mirror, get a loan, very different, right? And so and then the flip side of that is they were so loose, and then everything started to crumble, and they just stopped lending. And there's way too much that we don't have time to get into all of the nuances of that.
Yeah.
But liquidity basically went away,
mm-hmm.
And so some tightening is good in a number of ways because it's making sure they're not doing that. Getting that same scenario, but they're not overly tightening, right? There's still liquidity, there's still availability of products, so it's not completely going away. That's where you have that. That's really what it is. I don't want to say caused the crash, but it certainly didn't help it, right? Yeah. You can't get a loan, like who's gonna buy the inventory, and you end up with 18 months to 24 months of inventory because nobody can get a loan, right? Mm-hmm. So we're not there, and I don't know that is where we're going to head again. They're trying to manage it a lot better, right, this time around.
As far as from a lending perspective, I mean, you had the reason for a lot of all the inventory was forced credit selling. People from 05 through 08, foreclosures happening, people having to sell their homes because the loan products were the Wild West. Your ninja loans, they weren't good loans, and that has completely changed since 2010.
Absolutely. Well, how many people refinanced or purchased in the last few years when rates were 3%, right? It's and they're fixed. So completely different set of circumstances than back then. Plus, we had a glut of inventory, and we absolutely have no inventory right now. It's crazy, which we were talking about before the show here. There's just there's so many factors, and it's funny because people you see on social media and all that, people can just spout out whatever they want these days, right? And so whenever you're listening, including to me or Grant, make sure you know the source of and are they qualified to be giving an opinion, or are they just spouting crap that they don't know anything about, right? Because what people want to do is they want to point to one thing, right? They want to point to one factor and say, well, this is because of this. The market's going to crash. Oh, affordability is not there anymore, so the market's going to crash. Well, okay, number one, obviously it's not completely gone because people are still buying. Number two, that's one factor. You have inventory, you have affordability, you have all sorts of factors that are, you can't just look at one piece of it. I mean, you can, but you're not going to make an accurate conclusion from that. Inventory is extremely low. So it's ironically it's twice as high as it was this time last year, right? But it's still, at least here in Portland, but it's still less than 2 months of inventory. So again, that's a stat thing, right? Oh my gosh, inventory is twice what it was last year. Okay, well, what does that actually mean? It's still very, very low. Yeah, it's twice what it was last year, but it's still very, very low. It's still very much in the seller's market category as far as inventory levels. Are we fully in a seller's market? No, because there's some other factors to it. But from an inventory perspective, we certainly are, right?
I mean, the American homeowner is in the best position they've been in decades. Like you said, many purchased, refinanced, a rate into the threes, which I don't know, in our lifetime, it'd have to be some serious issues going on with America to get back to the twos and threes. For Fed intervention and whatnot, but people are set up really well because 30-year fixed debt. So many other countries have shorter term variable rates that are feeling the pinch as those are coming due. Like the commercial markets here, where you have shorter term 2, 3, 5 year balloon loans. You have bridge loans. The commercial markets are seeing a lot of stress right now, and there's more to come, more foreclosures on the horizon. But residential real estate being 30-year fixed, having more solid underwriting than we've ever had, better credit profiles than we've ever had. People are set up really well. Like, they don't necessarily have to move. They can sit and hunker down, enjoy their low interest rate, their lower monthly payment, and continue to see their equity build.
Yep, absolutely. And you hit on a key point that I don't want to gloss over. So, we talk about real estate like it's this one thing, right? Okay, well, you just talked about the commercial markets, right? Very different as far as what kind of loans people have been able to get, how it's reacting. People buy commercial real estate for the returns. They don't buy it to live there. So how do you buy a 4 cap property with debt that costs 8%? It doesn't make sense. It doesn't pencil unless you have some sort of huge value add play, or you're just really thinking long term and betting on rates coming down, or like growth long term. I mean, you can still make it work long term. It does not work today though, unless you put a gob of money down and have huge amounts of equity, or just parking your cash somewhere or something like that, right? To leverage and buy that doesn't make sense. And so, to your point, those loans are written where you have to refinance or do something in 5-7 years, or the rate's going to change, right? So the loan's going to be due, rate's going to adjust. So you're going to have to either sell or refinance. Well, rates are way higher, and cap rates are steady, I'd say, but no one's really buying because of that very reason. So you can't. All that to say, you can't just you can't say real estate is being affected this way. There are different sectors of real estate. There's commercial, and even within commercial, you've got industrial versus apartments versus office versus retail. I would not want to be in office right now myself, but there's also opportunity there too when there's challenges in the market. So and then obviously you have to look at your local market,
different regions of the country. That was what I was going to say
next. 100%. You can't say, oh, this is what's happening nationally, so this is what's happening in every market.
Like nationally, we're like 18, 19 days on market on average, but I think when we were talking a couple weeks ago, days on market in Portland Metro was like 30 to 32.
Yeah, it's like mid 30s to it might even be pushing 40. So which still isn't really that bad. That's pretty average. And so what I think what you're seeing on an inventory level, we talked about the low interest rates. People are stuck more or less, right? It's like, well, you have to have I keep saying you have to have a very compelling reason to make a move. You have to be for some reason forced to do it, or just some sort of life circumstance that is really pushing you to make that move.
And we're still seeing a lot of those buyers. People moving from Oregon, Arizona to Washington, whether it's to be near family, retiring, job change, that sort of thing. But they're also taking with them a lot of equity. Yes. So their monthly housing costs, they're able to still limit by putting a larger down payment, not financing as much.
And I was going to touch on that earlier when I was, people look at one thing and then they make a prediction in the market. So many people were like, oh, look at where interest rates are going, and now the market's going to pull back. And it did. I mean, it did. Last year, second half of last year was pretty rough on
June
prices.
through November, December.
I don't think here in Portland we're quite back to where we were before.
Pretty darn close.
Pretty close, yeah. So, again, I mean, yes, affordability changed big time, but people got to this sense. I think a lot of it was uncertainty, right? Rates rose so quickly that I wouldn't necessarily agree with it, but I could absolutely see how they go from 3% to 6.5%. Over the course of a few months. Okay, that's a little bit of a headwind in the market, right? So I can see why you would draw that conclusion, and so I think people just really hunkered down the second half of last year.
You see, like I was running scenarios for someone the other day that was newer to the market, and $400,000 loan amount, and at 3.25%, that's like with taxes and insurance, that's a $2,200-$2,300 a month payment. And that $400,000 loan, maybe only a $450,000 purchase price right now, where you're 7%, I mean, you are easily $3,400-$3,500 for the
huge
home,
difference.
which is crazy.
Huge difference. Yeah. So you've got all sorts of mindset things going on. You've got, the whole recency bias of, well, this is where interest rates were and what my payment would have been, last year, and prices haven't really changed. So I don't know. So now you got this hesitancy to buy, but I think people are starting to just, not everybody, but there's definitely a chunk of the population that's like, okay, well, I missed my window last year, or I wasn't ready, or whatever, but I still want to buy a house.
Yeah.
And they're just kind of coming to grips with where the market's at. There's a lot of tools with temporary buy downs and things like that, where you can help with that payment. Long term, if we're thinking rates are going to come back down, then it's a good potential strategy to keep your payment down now, refinance when rates come down. So with that said, so tell us, what are you thinking, crystal ball time?
I mean, we certainly have seen a lot of first-time home buyers adjust their expectations. Like, hey, this is the new reality, the 6s, the 7s. It's still tough for the market because there's so much instability, or there's so much fluctuation in rates. Like, someone gets pre-approved, okay, rates were at, month and a half, 2 months ago, they're at 6.25, 6.5, and they find a home, they get under, they're making offers, and okay, you're 7.25 on that house now. And that, just the fluctuation in what people knowing what to expect in terms of their housing payment is probably the toughest point. But a lot of buyers have come to grips. I mean, over the last 9 months, we've used a lot of tools like your 2-1 buy down, permanent buy downs, getting seller credit. That over the last month and a half has gotten a lot more challenging to use, because we're seeing 4, 5, 6 offers on a lot of properties, and whether that's Arizona or places here in the Portland metro, we're seeing more competition. So it's harder necessarily to get a discount on the property from list with that seller credit. We're still seeing a little bit of seller credit, but a lot of times it's going over list price and getting that seller credit, so that the net to the seller is still at or around what they have at list, just because they have multiple buyers. The back half of this year is going to be really interesting. I think we are going to see at least a quarter, if not 2 quarter-point rate hikes from the Fed, which again isn't directly correlated to mortgage rates. The big story is the jobs number. We had ADP come out this morning, July 6th, and it showed strength, like the unemployment rate going down, which is hard to stomach, because you're seeing a lot of these entities like ZipRecruiter, LinkedIn, Indeed, these different job posting sites are seeing a significant reduction in jobs or available postings. Like, we are seeing a tightening in the job market. It's just not being reflected in like your national, your business surveys, your household surveys, the BLS, ADP report. And so that's giving the Fed reason to continue to hike the Fed funds rate, because a lot of them grew up in the 1970s when wage inflation was we saw a pickback up in inflation when everyone thought it was dead, and that's what they're afraid of right now. Nothing in the data is showing us that is even remotely close, because rent inflation is coming down, wages are stabilizing, and we don't necessarily have to have a ton of layoffs or a spike in unemployment to have a recession. I think over the back half of this year, we will see improvement in mortgage rates. Getting to the 5s by the end of the year, I think, is unrealistic. Even if we could just get to 6.25, 6.5, and stay there.
I was going to say
stability is what we
need.
Exactly
what I was going to say is the stability piece, because you talked about it earlier. Like, it's hard to shop, especially if you're like just barely qualifying, right? How do you shop and then, I found the house and sorry, rates went up, right? So I don't know if people are using. Well, you can't really rate lock until you have a deal. It doesn't make sense, really.
There are different programs like Academy. We have a lock and shop program where someone could get pre-approved, lock for 90 days. The hardest part is finding the home, because if your lock is for 90 days, that means you need to find a home within 45 to 60 days that you get under contract with. Inspections, everything have to go well. And you're closing in 30 days before the end of that 90-day rate lock. But that certainly is an option, especially with all the volatility. We have clients every once in a while utilize that. It's just, that's one of the things I love about working for Academy, is we have so many different tools in our tool belt, where depending on the buyer's situation, we're not just conventional VA, FHA, your standard loan products. Like we have a vast array, especially in this market, to get more creative and help people buy homes, buy investment properties.
Yep. Which is a great. I mean, just overall, if you're stuck in a box, whether it's lending or a strategy with investing, you know, you don't want to get too spread out with your investment strategies and everything. You want to, you know, play in a certain arena, but you also don't. You want to think outside the box a little bit, right? Whether that's, you know, and have those options. Whether that's with your lending options, you know, as a developer, you see so many developers get, you know, stuck in there, like this is how we do it, and that's fine, it works for them, but it's like there's other opportunities that they're probably missing because they're just like so blinded. So, so yeah, having the right team that can have options for you versus like, oh yeah, here's your, you know, couple conventional inside the box options.
So many lenders, so many realtors, 95% of the industry just works with your common W-2 home buyer that is buying a primary residence. Okay, you qualify from a debt to income ratio standpoint, awesome, you can make an offer. Where, especially in this market, one of the best strategies for people to use is still house hacking. Like, whether that's buying a single family residence or a single family with an AU or a duplex, if you can find one on the market or find one off market through mailers, like to be able to offset your housing expense, get creative, rent out rooms. There's a lot more nuance when working with a house hacker, with an investor. There's so much more to the numbers than just, oh, you make this much income, payments this much, you qualify for a home. Finding a person like yourself or myself that specializes in that also does those things, invests, shares that similar mindset is really important right now. That creativity can make a deal where there might not be one just looking at it on the surface.
Exactly, yeah. And I think it takes asking the right questions, right? And said, I think it's Robert Kiyosaki said in Rich Dad Poor Dad, probably. He said, you don't say how. Well, I can't do that. You ask, how can I do that, right? So instead of saying, oh, interest rates are 7%, I can't buy a house, I can't buy an investment property. Instead of saying that, okay, I want to do this, how can I do it? Oh man, I can buy a duplex. That'll help a lot because interest rates are higher, but now I have income coming in from the second unit. You know, now my payment's back down where my net payment's down where it needs to be, right? Okay, well, I want to buy investment, so it's not going to cash flow as well. Maybe I need to adjust my strategy a little bit, right? So there's, you just have to sometimes, again, think outside the box, and you have to make those adjustments. If you're dependent on what the market is doing to be successful in your investing, then you probably need to have a little bit more flexibility in your investment, right? That's why, as an individual investor, you do have an advantage over some of these. Everybody gets scared of these big hedge funds and all that, but they move really slow. You can be nimble, and you can adjust a lot quicker to markets as an individual investor or as a smaller company, right? So, they're buying a lot of real estate, but there's still opportunity out there, and you have to be able to adjust and make those changes to adjust with the market. So there's always opportunity. We're always buyers. We're not always sellers, but we're always buyers for the right opportunities. Okay, well, any other comments on where we're heading that we're going to hold you to here over the next? No, I'm just kidding.
I mean, with the lending market being so strong, like you're not going to have forced credit sellers. You're going to see, I mean, I was listening to someone from auction.com the other day, like we're seeing a little bit of an uptick in foreclosures, but it's from like historically low levels. Like everyone likes to point to percentages, like, oh, it's a 50% increase, but it's like compared to 2019, we're like 30-40% of total typical foreclosure volume. And so like you're not going to, because the lending market, we're doing good loans in the residential space. Supply and demand is going to continue to be your driving factor. I mean, we've seen that in so many markets. There's so much demand. There's not enough inventory. You had a 6-month pause when rates and affordability shock set in. Now people have adjusted expectations. You're still getting buyers, multiple buyers offering on a turnkey or well listed, well priced home. Your homes that are a little bit more fixers might sit a little longer, as increasing your days on market, but homes that are ready to go are selling quickly still. But that supply demand in balance is going to be the driving factor even through the winter, which is not a traditional usually your peaks in inventory are around this time. Because things have been so abnormal, we could still see quite a bit of activity, even a little bit of drop in rates.
Yeah,
could spur people in the winter. There's just not enough supply.
There's not enough supply. Yeah, and there's certain price brackets where it's more competitive than others, but I would still say across most price brackets that it's if it's priced right and it's a good property, then it's not going to be there for very long.
Yeah.
And that goes from your entry level homes all the way up to your, a couple $1 million homes on acreage and everything. So, but yeah, I know we've talked about the data thing a couple of times on here. It's funny to me because my big thing is you have to look at the historical data. You can't look at. I mean, people were doing it, looking year over year sales are down. Well, yeah, they were like ridiculously high, and so of course they're down. Like even in a good market, they were going to be down because they were so high. And all of that, you just mentioned foreclosures. Oh, foreclosures are up. Yeah, they're historically low, like ridiculously low numbers. So, okay, an uptick means absolutely nothing unless you look at what's normal. And you look back, especially if you're going to say, oh, look, we're heading into what we were in 2008, 2009, 2010. We're nowhere even close to that. We're like a fraction of and it would take so much to get there from a foreclosure standpoint, right? Yeah. And I saw a post the other day in a real estate group that, this is just another example of data and just like how it means absolutely nothing unless you look at historical data. I think it was from National Association of Realtors. I could not find the article. I do not know where the data is, unfortunately, but because I was trying to verify. But it said something about only 8% of all members had 4 or more sales so far in the first half of 2023.
I saw that too.
Yeah, and so everyone's freaking out, like, oh my gosh, like this is crazy, like, and yes, I totally understand. There's agents that have done really well that are struggling right now. So I'm not discounting that, but my thing is you can't just look at that and say you have to check your mindset as part of it. Okay, 8%. Number one, I'm going to be in that 8%. Okay, so that's the first thing. Now, you're not in the 90%, you're in the top 10, okay? So you gotta check yourself there. Number two, we all know that there's so many part-time realtors. Well, I don't care what it was this year unless I know what last year was, which I couldn't find.
Yeah.
Because if it was 10% last year, it means nothing. It's like it's hardly any change. But I couldn't find it. I wish I could, because that's what I was trying to find, is compare it to last year. So all that to say, again, whenever you're looking at data, you have to look at historical trends on all of this stuff. You can't just look at one set of one place in time, year to date, year over year, all that stuff. It's important, but it really almost means nothing unless you look at the big picture and what is normal and what.
And 2021 and 22 have been such anomalies, from everything from economics to the pandemic, everything that has gone into that. You really have to look back to 2019 for a more normal housing market, and not looking so much at year-over-year percentages, but just looking at your base numbers. What is normal in like the 2019 housing market compared to now? Yeah, yep, for sure, yep. So again, just look. You gotta look at the past. You can't just be looking at today. If you want, only if you want accurate data to work off of. I think we do, but yeah, there's still lots of opportunity out there.
Oh, there's tons of it. Yeah.
90-10. Pareto's principle is 80-20. Like your top 10% are doing 90% of the volume. I'm not talking a ton. People ask about rates day to day, but like that is never my focal point, because or not Pollyanna positivity, but just having a positive mindset and outlook. Like the best is yet to come. The future is going to be better than the past. There's opportunity to be created, and people, it's so easy right now. There's so many different headwinds in the market to focus on the negative, but those that are having success, like you kind of alluded to, it's all about your mindset, finding the opportunity out there, still finding ways to serve and to help people. Because at the end of the day, that's our ultimate goal, is to help people achieve the dream of home ownership or build generational wealth through buying an investment property.
Yeah, or solve problems that sellers have, right? That's all part of being an investor. We're not out taking advantage of people, right? At least we shouldn't be. There are investors that do that. We're problem solvers, whether that's for a seller, whether that's for a client that we're helping buy a home or investment property, where our job is to solve a problem and get them from where they are to where they're trying to go. So, yep, and you can still do it in today's market. So there's lots of ways to do it. So, and a big part of it is just having clarity, right? What is it you're trying to accomplish, and then working it backwards from there and figuring out how to make it happen. So, awesome. Any last minute additions before we sign off here?
I'm excited for what's ahead. Thankful for great realtor partners. I work with multiple states. Thankful for past clients that keep referring people our way, keeping us busy despite this market. Looking forward to the future. Awesome. and keeping a positive outlook for sure.
So it's all about relationships.
Yes,
that's
sir.
What I hear there.
All about relationships.
Absolutely. Yep. Very good. Well, Grant, thanks again for being here. Great to get the insights as always.
Yeah, thanks for having me, Ben.
Awesome.